Hey everyone, welcome back to Corporate Decoder, Mitesco Inc. Just filed a Form S-1 and I am seeing a lot of moving parts that investors need to understand. Quick note, this is not financial advice, just my take on public filings for educational purposes today. We are diving deep into how this company is trying to restructure its massive debt and what it means for the stock. Alright, let's decode this S-1 filing from Mitesco Inc. This is a big one, essentially a new registration statement for a lot of shares being offered for resale by existing shareholders. Why is this happening? Well, it's tied to a massive debt restructuring and the conversion of preferred stock into common stock. The headline number here is over 106 million shares of common stock that could be sold by existing shareholders. This isn't new money coming into the company, it is about making shares held by lenders and other parties freely tradable. This happens when a company has a lot of debt or complex preferred structures, and it agrees to register those shares as part of a deal to clean up its balance sheet. Think of it like this: the company previously issued shares or promised to issue shares in exchange for cancelling debt or converting tricky financial instruments. Now, they are fulfilling a promise to let those original holders sell those shares on the open market. The company itself is not selling any shares here and will not receive any money from these sales. The company's strategy seems to be focused on clearing its past financial obligations. They brought in a lot of preferred stock and complex notes to restructure over $30 million in old debts from a prior business line, the Good Clinic. This current filing is a consequence of that restructuring, aiming to make those formerly restricted shares available for sale. Now, let's talk about the risks, because there are many Mitesco Incorporated acknowledges to raise substantial doubt about its ability to continue as a going concern. This is a really serious statement from the company itself, meaning they are not sure they can operate for the next year without significant financial trouble or needing more funding. This is often seen with companies that have a history of losses and haven't managed to generate enough sales to cover their expenses. For Mitesco Incorporated, their past clinic business was not profitable, leading to this situation. They are now pivoting to data center services and technology, but the path from having virtually no cash to being stable is a long one, and the odds are often stacked against companies in this position. Historically, companies with going concern warnings often face significant challenges, and many eventually fail or get acquired at severely depressed valuations. They are also very upfront about being in the early stages of their new business plan with limited track records. This means investors are essentially betting on a future vision rather than proven performance. The company has had a lot of debt and has been very active in trying to settle it through issuing stock, as seen in the sheer number of shares being registered for resale. This implies significant dilution for existing shareholders if all these shares find their way to the market. Let's look at the numbers. As of the 31st of March 2026, Mitesco Incorporated had a little over $1,500 in cash. That's not a typo. Compare that to close to $20 million in current liabilities. This is a critical imbalance. They have very little cash on hand to meet very large near-term obligations. The company's strategy has involved settling debts by issuing shares, which is common when a company is cash-strapped. However, this can lead to massive dilution. For Mitesco Incorporated, they are looking at issuing up to 86 million shares just from the redemption of series of preferred stock. And that's on top of shares already issued, and those potentially issuable from bridge notes. Their revenue for the 3 months ending March 2026 was zero revenue. While they had some revenue generated by their Cencor subsidiary in prior periods, it seems to have paused in the current quarter. This lack of current revenue makes the going concern warning even more pronounced. Their operating expenses for the same quarter were over $350,000, meaning they are spending money without bringing any in. The financial statements show a large amount of series of preferred stock liability, over $9 million in current liability, and over $4 million long term, which is slated for redemption. This means the company is on the hook to pay back this significant amount either in cash or common stock, which will further dilute existing shareholders. The company has also entered into multiple bridge notes, which are short-term loans that often come with high interest rates or punitive conversion terms. These notes in particular can lead to significant future dilution if converted into stock at a discount to market prices. When looking at the risk factors related to debt restructuring, they explicitly state that redeeming all shares of their series of preferred stock into common stock could lead to severe dilution, potentially over 90% for existing shareholders. This highlights the core issue. The company's past financial issues are causing significant upcoming dilution for anyone holding the stock now. Looking at the auditor's report reads a clear warning about substantial doubt concerning the company's ability to continue as a going concern. This is echoed in the company's own going concern note in the financial statements. It's a standard disclaimer. but seeing it repeatedly in different sections emphasizes the financial precariousness. This is similar to what we saw with Rite Aid, where a going concern warning foreshadowed significant operational and financial struggles. The company is trying to build new businesses in data centers and AI applications, which are promising sectors. However, they are currently in a state of extreme financial distress, relying on debt and equity issuances to survive while trying to turn things around. The sheer volume of shares being registered for resale suggests a significant overhang in the market, which can put downward pressure on the stock price. From a business strategy perspective, pivoting to data centers and AI is a logical move, as these are high growth areas. However, executing these strategies requires capital, which is precisely what the company seems to lack. They have noted they have no full-time employees and rely on consultants, reflecting a lean operational model, but also a potential lack of internal bandwidth to execute ambitious plans. With the stock trading on the OTCQB venture market, typically a market for smaller companies, and the current price being very low, the path to recovery is challenging. The company is explicitly labeled as a smaller reporting company, which allows for scaled disclosures, but also means they are not yet at a stage where they attract large institutional investment or analyst coverage. In conclusion, Mitesco Inc. is in a race against time to restructure its finances and execute a new business strategy. The S-1 filing reveals a company heavily burdened by past failures, undergoing a deep debt restructuring with significant upcoming dilution. While the pivot to technology is a positive step, the immediate financial situation, underscored by the going concern warning and minimal cash reserves, presents a very high-risk investment profile. The key question is whether their new ventures can generate revenue and cash flow fast enough to overcome the massive debt and dilution. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the research tools I use in the description.